You did nothing. That was the whole strategy. For 20 years, every time the world discovered the thing that was going to change everything, you did nothing at all, and it turned out to be the most profitable decision of your life. Go back 20 years. You are standing at the beginning of a long parade, though you do not know it yet. You have a job, an ordinary salary, and a single decision to make. You make it in 11 minutes on your phone. You set up an automatic transfer, $500 on the first of every month, into one total market index fund. Not a stock, not a bet. The whole market in one boring fund, bought automatically whether it is up or down, whether you are paying attention or not. You did not choose it because you were wise. You chose it because you were tired. You had spent about a year reading things, listening to people who all sounded certain and all disagreed with each other, and somewhere in that year you decided you were never going to be good at this. That is the honest origin of the whole plan, not conviction, surrender. A man at work set up the same thing the same month. Same fund, same amount, the two of you laughing about it by the coffee machine like men who had just joined a gym. Remember him. He comes back at the end of this. Then you stop paying attention. That is the part that matters, not the fund, the not paying attention. Because the parade begins almost immediately. 2 years in, everyone is buying houses, not to live in, to flip. The man at the barbecue explains that real estate only goes up, that he has 3 properties now, that you are being left behind by sitting in some index fund like a coward. He shows you the math on a napkin. The math is beautiful. It has no line on it for what happens if the price goes down, because that is not a thing that happens. He says, not to houses, not in this country, not ever. You nod, you do nothing. Your $500 goes into the boring fund on the first of the month, the way it does every month, and you forget the conversation by Tuesday. Your friend from work does not forget it. He pulls his money out of the fund to put together a down payment on a second property, because the napkin was very convincing, and because he was standing closer to the napkin than you were. 3 years in, the houses stop only going up. They go down all at once, and they take the whole market with them. The barbecue man loses all 3 properties and something behind his eyes. Your index fund falls by half of it gone on paper in a matter of months. The news uses the word collapse. Friends who own the same kind of fund sell everything, because watching the number fall is a specific kind of pain, and selling makes the pain stop. You do not sell, not because you are brave, because selling would require opening the app and you had gotten out of the habit. Your $500 keeps going in on the first of the month, except now it is buying the same market at almost half price, and you do not even notice you are doing the single smartest thing an investor can do, which is to keep buying while everyone else is running for the door. Your mother asks you at some point that winter whether your money is safe. You tell her you do not know. It is the truthful answer, and it does not comfort either of you. You go home and you do not change anything, mostly because you cannot think of what to change it to. The market comes back, it always has, but that is not the trend. The trend is what comes next. 6 years in, it is gold. The dollar is dying, they say. The whole system is a house of cards. Gold has hit the highest price in the history of the world, $1,900 an ounce, and a man on the internet with a serious voice explains that it is going to 5,000, that paper money is a scam, that the only real asset is the metal you can hold. A coworker you barely know converts a third of his savings into gold coins and keeps them in a safe. He shows you the safe. He is proud of the safe. You do nothing. Your $500 goes into the boring fund. Gold does not go to 5,000. It falls for years, cut almost in half by the time the panic burns off, and even when it eventually climbs back, it never comes close to what the boring fund quietly did over the same stretch. The coins sit in the safe, and no one makes a documentary about that part. 7 years in, the biggest social network on Earth goes public. This is not a fad, and everyone knows it. 1 billion people use the thing every month. Your cousin buys it in the first week at $38 a share, with money he does not really have, on the theory that you cannot lose betting on something 1 billion people already do. Within 4 months, the shares are worth about $17, less than half. He sells, because he needs the money for a wedding, and because holding it had started to feel like a joke people were telling about him. The company, of course, went on to become one of the most valuable businesses in human history. He was right about the company. He was right about everything except the only thing that pays, which is what he was going to do on the days in between. That is the trap almost nobody sees. Even the trends that win will destroy the people who bought them loudly and sold them quietly. You do nothing, your $500 goes into the boring fund, and a small piece of that fund is that same company, bought a little every month, at 38 and at 17 and at every price that came after, without a single decision on your part. 8 years in, it is machines that print objects. Plastic, then metal, then they promise human organs. Every factory on Earth is about to be replaced by a box on a desk. The shares of the two companies that make the boxes triple in a year, and there are articles, and there are conferences, and a man in your life who has never manufactured anything explains to you at a birthday party how manufacturing is about to end. The boxes were real. The revolution turned out to be slower and smaller than the conferences promised, and most of what did arrive went to other companies entirely. Those shares gave back almost everything, quietly, over the following 18 months, while everyone who had bought them found something else to be excited about. You do nothing. You could not have told him the names of the two companies. You did not know the argument. Not knowing the argument is what saved you from it. 10 years in, it is day trading. The apps are new, green and red and buzzing, free to trade, built to be opened 40 times a day, and more people discover that you can buy and sell a stock in the same afternoon and feel like a genius by dinner. Your neighbor quits his job to trade full-time. He has a strategy. He has 2 monitors. For about 5 months he is up and unbearable, and then he is not, and then he has a job again and does not talk about it. You do nothing. You could not have named a single stock you owned. That was the point. 12 years in, it is crypto. This one is different, they say, and this time they might even be right, but that is not the same as knowing what happens next. A coin that was worth a few $100s is suddenly worth almost 20,000. Your brother-in-law buys near the top, because the top is exactly when it becomes impossible not to hear about it. He tells you that you are going to miss the biggest wealth transfer in human history. He says it at a dinner table, in front of your family, and the way he says it makes you feel like a man explaining that he prefers to walk. You do nothing. The next year, the same coin loses more than 80%. 20,000 becomes 3. Your brother-in-law sells near the bottom, because the bottom is exactly when you cannot take it anymore. He bought high and sold low, which is the only truly reliable way to lose money, and he did it with total conviction the whole way down. Your $500 goes into the boring fund. 13 years in, it is marijuana. It is being legalized state by state and country by country, and this one is not even speculation. People say it is arithmetic. A company that grows the plant goes public in the summer at $17 a share. By September, it touches $300 in a single afternoon, briefly worth more than old American companies that build real things out of steel. 2 years later, it is worth a few dollars a share. The legalization happened exactly as predicted. The money went somewhere else, the way it usually does. Being right about the world and being right about the price are 2 entirely different jobs. You did not have either job. Your $500 goes into the boring fund. 15 years in, there is a plague. The market falls about a third in roughly a month. This one is different from the others because this one has bodies attached to it and nobody knows anything, and the number on the screen is falling in a way that feels less like a market and more like an ending. Your job is not certain. Nothing is certain. The word everyone keeps using is unprecedented. And this is the year you almost break. You open the app, not out of habit, you had no habit, but because your hands need something to do. You look at the number and you do the subtraction, and the subtraction is bad enough that you say it out loud to an empty room, and you find the button. You get as far as the screen that asks you whether you are sure. You sit there with your thumb over it for a while. Nobody sees this part. There is no version of this story where you look brave, because in that moment you are not brave, you are just slow. You put the phone down to do something else first, and you get distracted, the way you have been getting distracted for 15 years, and by the time you remember, it is late and you go to bed. Here is what would have happened if you had been slightly faster. The market bottomed in March, the single best day in more than a decade. The market up more than 9% in one day came the day after the bottom, not months later, the next day. And that is not a coincidence, it is the pattern. The biggest bank in America runs the numbers on the last 20 years and finds that missing just the 10 best days in the market cuts your total return roughly in half, and that 7 of those 10 best days happened within 2 weeks of the 10 worst days. The best days live next door to the worst ones. They are the same weather. To be there for the recovery, you have to still be holding during the part that makes you want to run. $10,000 left alone in the market over those 20 years became about 64,000. The same 10,000, missing only 10 days out of roughly 5,000, ends up near half of that. You kept your 10 days by being tired and a little disorganized on a Monday night in March. Your $500 went in on the first of the next month, into a market that had just been cut open, and it bought more shares than it had bought in years. Then the next year, the parade becomes a circus, the strangest boom anyone has ever seen. Stocks that should be dead triple in a week because a crowd on the internet decides to make them. People are buying pictures of cartoon monkeys for the price of a house. A coin invented as a literal joke becomes worth more than most real companies. There are companies going public with no business at all, just a famous name and a pot of money and a promise to find something to buy later. and people are handing them billions of dollars on that promise. Everything all at once only goes up, and the message everywhere on every screen is the same. This is a new world, the old rules are gone, and if you are still sitting in an index fund, you are the last fool at the party, you do nothing. 17 years in, the party ends the way parties always end. The cartoon monkeys become worth almost nothing within a year. A giant crypto exchange, run by a man they had called a genius, turns out to be empty, and it collapses in a single week and takes billions of dollars of other people's money down with it. The joke coin becomes a joke again. The stocks that tripled fall 90%. The companies with no business go back to being companies with no business. A whole generation learns, in one brutal year, that the old rules were not gone, they were just waiting. You did not learn that because you never forgot it. Your $500 went into the boring fund the whole time, through the boom and through the collapse, at the same steady pace it had kept for 17 years. Now here is the part that sounds like an exaggeration, and is not. There was a bet, a real one. In 2008, Warren Buffett, the most famous investor alive, bet $1 million that a single boring index fund, the same kind you own, would beat a hand-picked basket of the most elite hedge funds on earth over 10 years. These were not your brother-in-law and his app. These were the smartest, best-paid financial minds in the world, charging enormous fees for access to strategies ordinary people are not even allowed to see. They had teams, they had models, they had information you will never have. 10 years later, in 2017, the bet ended. The boring index fund returned about 7% a year. The genius hedge funds returned about 2%. Not one of them beat the fund that requires no genius at all. Buffett won by so much it was almost embarrassing, and the lesson underneath the headline was the one you had been living without noticing. The people who play the game the hardest usually lose to the people who refuse to play it. And it is not only the professionals. A firm called Morningstar studies what ordinary investors actually earn compared to what their own funds earn, not in theory, in their real accounts, and they find the same thing year after year. The average investor earns noticeably less than the very funds they are invested in because they buy after things go up and sell after things go down. They lose around 1% a year, roughly 15% of their total return, not to fees, not to bad funds, but to their own hands, to touching it, to chasing, to doing something. You did not lose that 15%. You could not chase what you refused to look at. But let us be honest about what it cost, because nobody ever is. Doing nothing for 20 years is not peaceful. It is not the serene monk on the mountain that people imagine when they say be patient. It is 20 years of being the least interesting person at the table. It is watching men you know become temporarily rich and finding out that you are not big enough to be happy for them. It is the specific humiliation of having no answer when someone asks what you are in, and saying just an index fund, and hearing your own voice do the thing where it apologizes. There was a dinner somewhere around year 12 where the whole table talked about coins for 2 hours. You did not say a word, not because you disagreed, you had no opinion, you had never had an opinion, that was the entire method, but because saying I have $500 a month going into a fund I have not looked at since the spring is not a contribution to a conversation. It is an admission of absence. You ate, and you nodded, and you drove home feeling like a man who had brought a sandwich to a banquet. There were entire years where you were sure you were wrong, not worried, sure, the gold years, the crypto years, the year of the monkeys, when a person you know made more in 4 months than you made at your job, and told everyone, and was not even gloating, which was worse. You never once felt smart, not one single day of the 20. You felt like a man who had missed something, over and over, for 2 decades, and the only reason you kept going was that changing it would have required a level of attention you had already decided not to spend. That is the real reason almost nobody does this. Not because the math is hard. The math is the easiest part. It is because the strategy pays you in nothing for 20 years and then pays you all at once, and human beings are not built to be paid at the end. 20 years in, you finally open the app because a form needs a number. You put in the same $500 a month for 20 years, which is $120,000 of your own money, spread across 2 decades so thin you never once felt it leave. The account reads about $360,000. You contributed $120. The market quietly in the background, while you ignored it, added almost $240,000 more. You sit with the phone in your hand for a minute. It does not feel like winning. It feels like finding out that something you forgot about had been working the whole time, which is exactly what happened. And then slowly you understand what the number actually is. It is not a boat. $360,000 does not make you rich, and anyone who tells you otherwise is selling something. What it is a set of doors that used to be locked. It is the ability to lose a job and treat it as a season instead of a catastrophe. It is a roof, a transmission, a hospital parking lot, all of them reduced from disasters to errands. It is being the one at the family table who can quietly help once when it matters, instead of the one who has to look at the floor. And if you leave it alone for another 10 years and keep feeding it, it is the difference between retiring because you chose to and working because you have to. You bought all of that in $500 pieces on the first of the month while completely ignoring the thing you were buying. Your brother-in-law who caught every wave the moment it was breaking, who bought the gold and the crypto and the monkeys and the meme stocks, who put in the same kind of money over the same 20 years, has a little more than he started with, maybe 140,000. He was not stupid. He was not lazy. He was the opposite of lazy. That was the problem. He did something every single time, and every single time, the something was buying excitement at its most expensive and selling regret at its cheapest. And the man from the coffee machine, the one who started the exact same fund on the exact same day with the exact same amount, he has nothing from it. Not because he lost it in the housing crash, though he did lose the second property, because he stopped the transfer in year 2 and never started it again. He is not a cautionary tale about risk. He is a cautionary tale about interruption. He made one decision, the same good decision you made, and then he made a second one. 20 years later, 3 men, roughly the same money, roughly the same jobs. The difference was not intelligence, and it was not luck, and it was not access. It was who touched it. You did nothing, and nothing, it turns out, is not the absence of a strategy. It is the strategy almost no one can execute because it feels like weakness the entire time you are doing it. Every trend was real. That is what nobody tells you. The housing boom was real. The gold spike was real. Crypto was real. Day trading was real. Legal marijuana was real. The meme stocks were briefly, insanely real. None of them were lies. They were just noise, and noise is not the same as opportunity, and the tragedy is that they feel identical in the moment, right up until the moment they do not. You could not tell the difference either. You just decided you did not have to. You decided 20 years ago that you would not try to catch the wave, any wave, ever, and that one decision quietly protected you from every mistake the confident people made. You are not richer than them because you were smarter. You were almost certainly not smarter. You are richer than them because you were still, and they were busy, and over 20 years stillness compounded and busyness bled out. The parade is still going. There is a new thing right now today that is going to change everything, and it has a serious voice behind it and a chart that only points up in a crowd that is certain you are being left behind. Maybe it is even real. It probably is, at least partly. It does not matter. Your $500 goes into the boring fund on the first of the month. You close the app. You do nothing. You have gotten very good at it.